Would you rather have $100 today or a brand new Mercedes next year?
That is quite the hypothetical to throw out right away.
I know it sounds a little ridiculous at first, but I want you to really think about it for a second. Your answer to that bizarre scenario actually reveals a lot.
It reveals your personal discount rate.
Exactly. It exposes whether you're fundamentally wired as a spender or, well, an investor. Welcome to the deep dive, everyone. Today, our mission is to tackle what is probably the ultimate question in modern finance.
Can you actually beat the stock market?
Right, can you beat it? And to unpack this for you, we're looking at two radically different sources today. They approach this exact same question, but from complete opposite ends of the intellectual spectrum.
It's a really fascinating study in extremes. On one side, we have this highly accessible, practical guide. It's called Stock Investing 101 from the Young Investors Society.
Which is great, very foundational.
Right. It breaks down the classic philosophical fundamentals of value investing. But then on the other side, we have this dense, highly complex academic paper from 2022.
Oh man, it is dense.
It really is. It's by researchers Xavier Brudy and Mathieu Garcin. The title alone is a mouthful, a statistical test of market efficiency based on information theory.
The contrast is just striking. I mean, the Young Investor's Guide uses everyday metaphors. Like, they talk about a box of donuts to illustrate how a company retains its intrinsic value.
And the academic paper is operating entirely in the realm of advanced statistical math.
Yeah, they use this concept called Shannon entropy, which we'll get into. They literally convert asset prices into binary code and use rolling data windows just to mathematically test if market movements are predictable.
But the brilliance of pairing these two sources together is that despite originating from completely different universes,
One is qualitative, the other purely quantitative.
exactly, despite that, they both lead us to the exact same inescapable conclusion about finding a true edge in the markets.
They use completely different frameworks to tell the same overarching story. And to really appreciate that story, we have to establish the baseline mechanics of time and capital.
Right, which the Young Investor's Guide does beautifully. It frames the whole concept of investing simply as a negotiation with your future self.
It's just a question of how much you believe tomorrow can offer in exchange for sacrificing a little bit of liquidity today.
The guide uses this classic example of a 20-year-old fireman to show the sheer mechanical leverage of compound interest over time.
Yeah, let's walk through that math. It isn't exactly new to anyone who follows finance, but it's crucial. So this fireman saves just $1,000 a year for 50 years. If he just hides it under his mattress.
He ends up with exactly $50,000.
Right. 50 grand.
Which, when you factor in half a century of inflation, is actually a massive destruction of purchasing power.
It's brutal. So he seeks a return. If he buys bonds or real estate yielding a historically stable 3%, that $50,000 grows to about $116,000.
A step up, for sure.
But if he moves into the S&P 500 and captures the historical average of 9.8%, that sum balloons to over $1.35 million.
That's the magic right there.
It is. But the guide pushes this even further to illustrate the real stakes of our main question today. If this investor does the grueling work, finds a legitimate edge, and manages to beat the market with a 20% annual return over that same 50-year period,
The numbers get crazy.
that identical $1,000 annual investment turns into $109 million?
That disparity between 1.3 million and 109 million is the perfect illustration of why Albert Einstein supposedly called compound interest the eighth wonder of the world.
The scaling is just entirely exponential.
And the source also notes something else interesting. If our hypothetical investor simply started at age 15 instead of 20, just catching the historical market average, that 1.35 million nearly doubles.
To over $2.2 million just by starting 5 years earlier.
Time is the ultimate multiplier. It makes the pursuit of beating the market incredibly lucrative, but obviously incredibly difficult.
Right, because chasing those alpha returns means stepping into the arena of the stock market. And that requires navigating some intense volatility. Which brings us to Benjamin Graham's legendary metaphor.
Mr. Market.
Yes, Mr. Market. If you're going to invest in individual equities, Graham says you should imagine you own a business alongside a partner named Mr. Market.
And he's a generally accommodating partner, but he suffers from these wild, unpredictable mood swings.
He really is the personification of market psychology.
One day he wakes up absolutely euphoric. The macroeconomic sun is shining, everything is great, and he offers to buy your half of the business for an outrageous premium.
But then the very next day, a minor piece of bad news breaks. He becomes totally depressed, convinced the world is ending, and begs you to buy him out for pennies on the dollar.
Mr. Market strips away this illusion that the stock market is a perfectly rational, calculating machine. It's an ecosystem driven by human emotion. It swings violently from irrational exuberance to absolute panic.
So the goal of the intelligent investor, according to fundamental theory anyway, is to remain totally stoic.
You have to ignore the erratic mood swings. You wait for Mr. Market to fall into a deep pessimism.
That's the moment you step in and buy an asset for significantly less than its intrinsic value. You're basically buying a $10 bill for $5.
But the challenge for you as the investor is accurately determining what that $10 bill is actually worth.
Exactly. What is the intrinsic value? The 101 guide walks through a simplified valuation of Apple to ground this concept.
It reminds us of a core tenet of fundamental analysis. A company's value is not simply its current profit margin.
Right. If Apple sells 200 million devices at $1,000 each, that's $200 billion in revenue. If it costs $800 to make each device, the profit is $40 billion. But that $40 billion is only a snapshot.
The true value of the business is the discounted value of its future cash flows. And forecasting that future growth is where the math turns into an educated guess.
It really does. The guide points out that if Apple grows its profits by just 5% annually for the next 40 years, the present value of the company is roughly $675 billion.
Which works out to about $111 a share in their example.
But here is the aha moment. If you tweak those assumptions even slightly, the valuation collapses. If the growth flatlines to 0%, the total value drops to $391 billion, or $64 a share.
And if a competitor disrupts their market share, causing growth to spike and then crash down the line, the value plummets to $220 billion.
Just $36 a share? It's a huge variance.
Because forecasting decades into the future is inherently flawed, investors develop heuristics, the most prominent one being the price to earnings, or PE, ratio.
It's basically a shorthand for the payback period. How many years of current earnings it takes to cover the purchase price.
The guide establishes a good baseline for this. Average companies might trade at a 15 times multiple. Highly profitable market leaders might command 20 to 25 times.
And struggling businesses usually sit below 10.
But relying on a PE multiple still leaves you exposed to future uncertainty. This is exactly why Benjamin Graham insisted on a margin of safety.
And Warren Buffett evolved that concept into the economic moat.
Precisely. An economic moat is a structural competitive advantage. It could be brand loyalty, patents, network effects, whatever defends those future cash flows against competitors.
Because if you identify a company with a wide moat and you have the discipline to wait for Mr. Market to offer it at a steep discount, you insulate your portfolio against the inevitable errors in your long-term forecasting.
That margin of safety approach makes perfect intuitive sense to a value investor. You do the fundamental research, identify the moat, and exploit the emotional mispricing.
But, and this is where it gets really interesting, if we pivot to our second source, classical financial academia historically viewed this entire methodology as a complete waste of time.
They absolutely did. And this philosophical clash came to a head in a legendary debate at Columbia Business School in 1984.
It was a defining moment in modern financial theory. On one side of the debate, you had Michael Jensen, brilliant academic, representing the consensus view of the era.
Jensen argued that any investor who manages to beat the stock market is simply the beneficiary of statistical luck. He famously compared active stock picking to a massive national coin flipping contest.
I love that analogy. It's brilliant in its simplicity. He basically said, if you have 225 million people flipping coins once a day, statistical probability dictates that a handful of people will eventually flip heads 50 times in a row.
And they will look like absolute geniuses to the outside world.
Right, they'll write books, they'll launch hedge funds, but their success is derived purely from random chance, not skill.
But Warren Buffett stepped up to counter Jensen with an equally devastating observation. Buffett acknowledged the coin flip statistics, but he added a crucial caveat.
He asked the audience to imagine what would happen if you investigated the winners of that contest and discovered that a disproportionate number of them all hailed from the exact same small town of Omaha, Nebraska.
Or, more pointedly, what if they all strictly adhered to the exact same value investing principles taught by Benjamin Graham?
Exactly. When the winners all share a specific intellectual framework, you can no longer attribute their success to random luck. It becomes evidence of a proven methodology.
The friction between Buffett's reality and Jensen's theory existed because academia was entirely anchored to the efficient market hypothesis, or EMH.
The absolute cornerstone of classical financial theory. It posits that financial markets are perfectly efficient. Under EMH, the price of a stock at any given moment already reflects all available information.
Under a strict interpretation of EMH, Mr. Market's mood swings are an illusion. Every price movement is a rational adjustment to new data.
The hypothesis is traditionally broken down into three forms, right?
Yes. The strong form argues that prices reflect absolutely all information, including hidden insider knowledge. The semi-strong form suggests prices reflect all publicly available information, like earnings reports and macroeconomic data.
But the 2022 academic paper by Brody and Garcin that we're examining today zeroes in specifically on the weak form of EMH.
Weak form efficiency claims that current asset prices fully reflect all past prices.
And the implications of weak form EMH for you as an investor are profound. If the weak form holds true, historical price charts are entirely useless.
Statistical arbitrage, the practice of generating consistent returns by trading on historical patterns or mean reversion, would be mathematically impossible.
Mr. Market wouldn't exist. The market would operate as a perfectly priced, unbeatable random walk.
Now, fundamental investors have always known anecdotally that the market is occasionally irrational. The immense challenge has always been proving that irrationality mathematically without relying on subjective metrics like PE ratios.
Which brings us to why the Brody and Garcin paper is so compelling. They set out to rigorously test the efficient market hypothesis, but they completely discard fundamental analysis.
They utilize a framework from outside the realm of finance entirely. They use information theory.
They strip away the narrative entirely. They ignore what the company manufactures, the strength of its moat, the quality of its management. None of it matters to them.
Instead, they take a time series of daily stock prices and convert that raw data into a simple binary code.
Just ones and zeros. If an asset's price closes higher than the previous day, it's recorded as a 1. If it closes lower, it is recorded as a 0.
They reduce the chaotic emotional stock market into a pure stream of ones and zeros. So a sequence where a price drop is followed by 2 days of gains is recorded simply as 0, 1, 1.
By binarizing the data, they eliminate the noise of magnitude. They don't care if the stock went up by 10% or 1%.
They are solely focused on testing for sequence memory, and they do this to apply a concept known as Shannon entropy.
This was developed by Claude Shannon, the father of information theory, right?
Yes. Entropy measures the amount of uncertainty or unpredictability in a given system or sequence.
So if we map Shannon entropy onto the weak form efficient market hypothesis, an ideal, perfectly efficient market should exhibit maximum entropy.
Meaning it should be completely and totally unpredictable. In a perfectly efficient market, knowing the historical sequence of ones and zeros provides zero predictive power regarding the next number in the sequence.
The probability of the next trading day resulting in a 1 or a 0 should permanently remain at exactly 50-50.
It is the literal mathematical equivalent of Jensen's fair coin toss.
So the researchers took this theoretical concept and built a sophisticated statistical estimator. They used it to measure what they termed market information.
This metric calculates the mathematical difference between the theoretical entropy of an ideal, perfectly efficient market and the actual entropy observed in the real-world market data.
If the efficient market hypothesis is an absolute truth, that difference must be 0. The real market would mirror the ideal market perfectly.
However, if that calculated difference is greater than 0 and it passes the threshold of statistical significance, it means the market possesses memory.
The sequence of ones and zeros actually contains an underlying pattern.
It proves that the next price movement is not a random 50-50 coin toss, and that it can actually be predicted with a probability greater than chance.
And they didn't just theorize this. They took their Shannon entropy estimator and applied it to real-world financial data from the year 2021.
To capture the dynamic nature of markets, they didn't just look at the year as a whole. They analyzed the data using rolling windows of 100 business days.
That 100-day rolling window is a really critical detail. It acknowledges that market efficiency isn't a static trait.
A market might behave rationally for months and then descend into a period of inefficiency driven by a macroeconomic shock or a speculative frenzy.
It tests whether Mr. Market goes through prolonged phases of irrational behavior.
When they ran the data across various asset classes, the results were highly illuminating. They began with the Russell 2000, which is a massive index tracking 2,000 small-cap companies.
And what did they find there?
The estimator revealed that they could never reject the efficient market hypothesis for the aggregate index. Throughout the observed periods, the Russell 2000 behaved as a highly efficient, unpredictable system.
Which actually aligns with statistical logic when you think about it. When you combine the daily price movements of 2,000 different companies, the localized irrationality and individual corporate noise sort of cancel each other out.
The macro-level index smooths the data into a highly efficient random walk.
But then they applied the test to the cryptocurrency market, specifically Bitcoin against the US dollar.
Given the famous volatility and speculative nature of crypto, conventional wisdom might assume it to be highly inefficient. Yet, the researchers found that they could only reject market efficiency 4.2% of the time.
That is wild. Bitcoin was remarkably efficient in its unpredictability. The extreme volatility does not equate to predictability. The sequence of ones and zeros for Bitcoin remains stubbornly close to a 50-50 random distribution.
But the academic paper delivers its most profound breakthrough when evaluating smaller, more concentrated pools of assets.
They ran their entropy estimator on the French CAC 40 index. This is a benchmark tracking 40 major French equities.
And the mathematics revealed that this market was statistically inefficient, 60.8% of the time.
60.8%. With a 95% confidence level, the math proved that the CAC 40 was operating with memory. It was behaving predictably.
They pushed the analysis even deeper. They isolated a single individual stock from within the previously efficient Russell 2000 index. It was a technology consulting firm called Perficient.
And for that single equity, the market was found to be statistically inefficient 57% of the time.
This is the precise intersection where our two vastly different sources align perfectly.
The dense, complex mathematics of information theory empirically proves what the accessible Investing 101 guide teaches conceptually.
Market inefficiencies are not a myth. They are a mathematical reality.
Broad, massive indexes like the Russell 2000 might successfully mask the irrationality. They appear to the outside observer as an unbeatable, efficient machine.
But when you zoom in on individual stocks or highly concentrated indices, the inefficiencies are exposed. At the micro level, human psychology still heavily influences the sequence of ones and zeros.
Because human emotion is prone to overreaction and panic, the sequence does not maintain a perfect 50-50 equilibrium. Identifiable patterns emerge within those 100-day windows.
And those patterns signify moments when Mr. Market has lost his rationality, creating tangible opportunities for statistical arbitrage.
It provides empirical validation for the active investor. Let's synthesize the journey we've taken through these sources today. We started with the foundational mechanics of time, recognizing that investing is fundamentally about delaying gratification to capture the exponential power of compounding.
We explored how to value a business based on the present value of its future cash flows, and the necessity of an economic moat to defend against the inherent inaccuracy of long-term forecasting.
We then crossed over into cutting-edge information theory, utilizing Shannon entropy and binary data conversion to mathematically dismantle the absolute authority of the efficient market hypothesis.
The definitive takeaway for you as an investor is this: the academic data confirms that the herd is occasionally wrong.
Whether you adopt the methodology of Warren Buffett, spending your time meticulously analyzing fundamental cash flows, management quality, and competitive modes,
or whether you deploy sophisticated mathematical models to detect binary data imbalances, the underlying philosophy is identical.
Mr. Market exists. He regularly misprices assets.
The opportunity to achieve alpha and beat the market is real, provided you have the strategic discipline and the emotional temperament to exploit those inefficiencies when they arise.
It is incredibly validating to see the theoretical debate from 1984 resolved with modern statistical proof. The market can be beaten. But I want to leave you with a final provocative thought to consider long after we wrap up today.
The Brudi and Garcin paper proves that we can mathematically pinpoint the exact moments a market descends into irrationality by detecting entropy imbalances in the price sequences.
And we live in an era where massive institutional trading algorithms are aggressively programmed to scan for these exact informational imbalances in real time.
If global supercomputers are constantly hunting for statistical arbitrage, executing trades at the speed of light to exploit these very patterns, will the machines eventually cure Mr. Market of his mood swings?
Are we rapidly approaching a financial future where the only conceivable way to beat the market is to possess the absolute fastest computer on the exchange? Or will the unpredictable, chaotic nature of human emotion always find a way to introduce fundamental inefficiency into the system?
It is something to keep in mind the next time you analyze a volatile stock chart.
Thanks for joining us on the Deep Dive.